Hello, and welcome to Veritas. Today we embark on a fascinating journey through the annals of American economic history, guided by one of its most enduring and recognizable symbols, the Dow Jones Industrial Average. For over a century, this iconic index has served as more than just a collection of stock prices. It has been a daily chronicle of the nation's industrial might, its periods of soaring optimism, and its moments of profound crisis. Before we start, I would like to know where you are watching this video from, and what time is it? Let me know in the comments down below. Also, while you are at it, please do like and subscribe, so we can bring out more content like this. Now let's get started. The late 19th century in America was an era of profound transformation. It was a period often romanticized as the Gilded Age, yet beneath the glittering surface lay a complex tapestry of industrial might, burgeoning wealth, and often bewildering economic volatility. Cities swelled with new arrivals, and factories roared to life across the landscape. The nation's infrastructure, particularly its railroads, expanded at an astonishing pace, knitting together a vast continent. This was a time when the very fabric of American life was being reshaped by innovation and enterprise. At the heart of this economic whirlwind, the stock market was rapidly evolving. It moved from a niche pursuit of the wealthy into a more accessible, albeit still opaque, arena for investment and speculation. Yet, for all its growing importance, the market lacked a clear, consistent means of articulation. There was no reliable pulse by which its health and direction could be measured. This was true for the common observer and even the seasoned financier. In this landscape of rapid growth and financial ferment, the need for clarity became increasingly urgent. The stock market, centered primarily on Wall Street in New York City, was a chaotic, often bewildering place. Information was fragmented, and rumors spread like wildfire. The true state of the market, beyond the daily fluctuations of individual stocks, remained elusive to all but a select few insiders. Investors, both large and small, struggled to discern patterns. They needed to understand whether the overall trend was one of expansion or contraction, optimism or despair. They needed a guide, a simple yet authoritative voice that could cut through the noise. This voice would provide a meaningful summary of the market's collective wisdom or folly. It was into this void that two remarkable individuals, Charles Henry Dow and Edward David Jones, stepped forward. They came not with a grand financial theory, but with a practical journalistic vision. This vision would forever alter how the world understood its economic heartbeat. Charles Henry Dow, born in Sterling, Connecticut in 1851, was a man of quiet intellect and keen observation. He began his career not in finance but in journalism. He honed his skills as a reporter in Springfield, Massachusetts, and later in New York City. His early experiences instilled in him a deep appreciation for factual reporting and the power of clear, concise communication. Dow possessed a unique ability to distill complex information into understandable narratives. This skill would prove invaluable in the bewildering world of finance. He was not a speculator or a trader in the traditional sense, but rather an analyst. He was driven by a desire to bring order and understanding to the seemingly random movements of the market. He believed that the market, despite its daily gyrations, contained underlying trends. If properly observed and measured, these trends could reveal the true state of the nation's industrial health. Edward David Jones, a statistician by training, was Dow's perfect complement. Born in Worcester, Massachusetts in 1856, Jones brought a rigorous, analytical mind to their partnership. Where Dow sought to interpret and explain, Jones sought to quantify and categorize. He had a meticulous attention to detail and a passion for data. He recognized that patterns could only emerge from careful, consistent measurement. Together, their combined talents formed a formidable duo. Dew was the insightful interpreter and communicator, and Jones was the precise statistician and data organizer. They shared a common conviction that reliable financial information, presented clearly and consistently, was not just a service to the wealthy elite, it was a fundamental requirement for a healthy, functioning capitalist economy. Their partnership was founded on the principle that transparency and objective analysis were essential for investors to make informed decisions, thereby contributing to a more stable and rational market. In 1882, Dow and Jones, along with Charles Bergstresser, founded Dow Jones and Company. Their initial venture was modest, operating from a small office near the New York Stock Exchange. They began by distributing handwritten news bulletins, known as flimsies, to brokers and bankers on Wall Street. These early dispatches were revolutionary for their time. They provided timely and accurate information on market movements, company news, and economic developments. Prior to their efforts, much of the financial news was anecdotal, often biased, and frequently delayed. Dow Jones and Company aimed to change this. They established a reputation for integrity and speed, quickly becoming an indispensable source for those who needed to stay ahead in the fast-paced world of finance. Their commitment to unbiased reporting and factual accuracy laid the groundwork for their later, more ambitious projects. The success of the flimsies demonstrated a clear demand for more comprehensive and accessible financial news. This led Dow and Jones to launch the Wall Street Journal in 18. The newspaper quickly became the flagship publication of Dow Jones and Company. It provided in-depth analysis, market commentary, and detailed financial data to a broader audience. It was through the pages of the Wall Street Journal that Dow would articulate his theories about market behavior. Crucially, he would introduce his innovative statistical averages. The journal was not merely a chronicle of daily stock prices. It was designed to be an educational tool. It empowered investors with the knowledge they needed to navigate the complexities of the market. It was a bold step, transforming the fragmented whispers of the trading floor into a coherent daily narrative for a growing readership. Before the advent of the industrial average, Dow had already begun experimenting with other indices. Most notably, he created the Dow Jones Railroad Average. In the late 19th century, railroads were the undisputed titans of American industry. They were the arteries of commerce, transporting raw materials to factories and finished goods to markets. They connected disparate parts of the country and facilitated the growth of cities. Their health was inextricably linked to the nation's economic vitality. Consequently, railroad stocks dominated the trading volume on the New York Stock Exchange. It made perfect sense, therefore, for Dow to first focus his efforts on creating an average that reflected the performance of these crucial companies. The Railroad Average, first published in 1884, served as an early prototype. It demonstrated the utility of aggregating individual stock prices into a single representative figure. It was a significant step, providing a clearer picture of a vital sector than had ever been available before. However, as the American economy continued to diversify and mature, it became evident that relying solely on railroad stocks, no matter how dominant, provided an incomplete picture of the nation's industrial progress. New industries were emerging, driven by innovation in manufacturing, energy, and consumer goods. Companies involved in sugar refining, tobacco, cotton, and various other industrial pursuits were gaining prominence. Their growth signaled a broader economic transformation beyond the tracks and train cars. Dow, ever the keen observer of economic shifts, recognized that a new average was needed. This new average would capture the essence of this burgeoning industrial might. He understood that the market was a reflection of the real economy. If the economy was evolving, so too must its primary barometer. This realization set the stage for the creation of his most enduring legacy. On May 26, 1896, Charles Dow published the first Dow Jones Industrial Average in the Wall Street Journal. This was not merely an update to an existing index, it was the birth of a new economic icon. The initial average comprised just 12 companies. This was a seemingly small number, yet they were carefully selected to represent the leading industrial enterprises of the era. These were the giants of their time. Their operations and profitability were seen as indicators of the broader health of the American manufacturing sector. Their names, though many are now unfamiliar to the modern ear, were synonymous with progress, innovation, and the very foundation of the nation's economic engine. Each company, in its own way, contributed to the industrial tapestry that Dow sought to measure. The original 12 companies were American Cotton Oil, American Sugar Refining, American Tobacco, Chicago Gas, Distilling and Cattle Feeding, General Electric, Laclede Gas, National Lead, North American, Tennessee Coal, Iron and Railroad, U.S. leather, and U.S. rubber. Let us consider each of these pioneering constituents for a moment, to understand the industrial landscape they collectively painted. American cotton oil, for instance, was a major player in the agricultural processing sector. It transformed cotton seeds into oil for various uses, including food products and industrial applications. Its inclusion highlighted the importance of agricultural commodities and their processing in the national economy. American sugar refining, another significant food processor, dominated the sugar industry. Sugar was a staple of the American diet and a key commodity in international trade. Its presence underscored the consumer goods sector's growing influence. American tobacco, a powerful trust, represented the burgeoning consumer market for tobacco products. This was a highly profitable and widely consumed commodity at the turn of the century. Its inclusion reflected the rise of large consolidated corporations that controlled significant market share. Chicago Gas and Lockheed Gas, St. Louis were utility companies. They provided essential services like lighting and heating to rapidly expanding urban centers. Their presence in the average acknowledged the critical role of infrastructure and public utilities in supporting industrial growth and improving quality of life. Distilling and cattle feeding, though its name might sound archaic today, was a major producer of spirits and a significant agricultural processor. It tied into both the consumer market and the agricultural supply chain. General Electric, even then, was a beacon of innovation. It was a company at the forefront of electrical technology. Its inclusion was a testament to the transformative power of electricity and its application in industry and homes. GE's presence signaled Dow's foresight in recognizing the importance of emerging technologies, even if the industrial label was still broadly applied. National Lead, as its name suggests, was involved in the production of lead-based products. These were used in paints, pipes, and various industrial applications, reflecting the foundational materials industries. North American was a diversified holding company with interests in utilities and transportation, showcasing the complex financial structures emerging in the corporate world. Tennessee Coal, Iron and Railroad was a major integrated industrial concern. It was involved in mining, steel production, and railroad transportation. Its inclusion highlighted the critical importance of heavy industry, particularly steel, which was the backbone of construction, infrastructure, and manufacturing. U.S. Leather, as its name implies, was a dominant force in the leather industry. It supplied materials for shoes, belts, and other goods, reflecting the consumer and manufacturing sectors. Finally, U.S. Rubber was a leading manufacturer of rubber products, from tires to industrial components. This underscored the growing importance of new materials and the burgeoning automobile industry, even in its nascent stages. Together, these 12 companies represented a cross-section of the most vital and dynamic sectors of the American economy at the close of the 19th century. The calculation method for the first Dow Jones Industrial Average was remarkably simple. It reflected the technological limitations of the era, and Dow's desire for an easily understandable metric. It was a simple arithmetic average of the prices of the 12 constituent stocks. To arrive at the average, Dow would sum the closing prices of each of the 12 stocks, and then divide that sum by the number of stocks, which was 12. This made the average straightforward to calculate by hand, a crucial consideration in a time before electronic calculators and computers were commonplace. The simplicity was a deliberate choice, intended to make the average accessible and transparent to a wide audience, from the seasoned investor to the curious newspaper reader. However, this simplicity also introduced a fundamental characteristic, and later a significant criticism, of the DJIA: its price-weighted nature. Unlike modern market capitalization-weighted indices, where companies with larger market values exert a greater influence on the index's movement, the DJIA gave equal weight to each dollar of stock price. This meant that a stock trading at $100 would have 10 times the impact on the average as a stock trading at 10. This was true regardless of the company's actual size or economic importance. While this was a practical solution for its time, it meant that the average could be disproportionately influenced by the movements of its highest-priced components, a characteristic that would become more pronounced and debated in later decades. The initial reception of the Dow Jones Industrial Average was not one of immediate widespread acclaim, but rather a gradual acceptance. In its early years, the average was just one of many indicators, and its significance was still being established. The financial community was accustomed to tracking individual stocks or relying on anecdotal evidence. Dow and Jones had to patiently educate their readership on the utility and meaning of this new aggregate measure. They used the Wall Street Journal as their primary platform, consistently publishing the average, explaining its components, and using it as a basis for their market commentary. Their persistent efforts slowly but surely built credibility and demonstrated the average's value as a concise summary of market trends. The economic climate in the years immediately following the DJIA's debut was characterized by periods of both growth and contraction. This reflected the inherent cyclicality of the industrial economy. The late 1890s saw continued industrial expansion, but also periods of financial panic and recession, such as the Panic of 1896 and the Panic of 19. The Dow, in its nascent form, moved in tandem with these broader economic currents. It offered a new lens through which to observe the market's response to these events. It provided a tangible number that could be tracked over time, allowing observers to quantify periods of prosperity and downturn, rather than relying solely on qualitative descriptions. This numerical representation was a powerful innovation, giving a concrete shape to the abstract concept of market performance. For the first few years, the DJIA remained relatively obscure outside of a dedicated readership of the Wall Street Journal. Its influence grew steadily, as more people recognized its utility. It wasn't just a collection of numbers, it was a tool for understanding the broader narrative of American industry. Dow himself continued to refine his theories. He eventually developed what would become known as Dow theory. This theory posited that market trends could be discerned by observing the movements of both the industrial and railroad averages. This theoretical framework further cemented the DJIA's importance, elevating it from a simple average to a component of a more comprehensive analytical system. The early 20th century brought significant changes to the DJIA. The number of components was increased to 20 in 19. This reflected the growing diversity and scale of American industry. This expansion was a recognition that 12 companies, no matter how carefully chosen, could no longer adequately capture the breadth of the nation's industrial output. As new industries emerged and existing ones grew, the average needed to adapt to remain representative. This flexibility in its composition, allowing for the addition and removal of companies, ensured its continued relevance as the American economy evolved. This is a practice that continues to this day. The decision to expand was a pragmatic one, driven by the need to maintain the index's accuracy as a barometer. The outbreak of World War I in 1914 brought unprecedented challenges and opportunities to American industry, and consequently, to the stock market. The Dow, now with 20 components, reflected the dramatic shifts in production as the nation geared up to supply the Allied powers, and later, to enter the conflict itself. Industries like steel, chemicals, and armaments saw massive expansion, while others faced disruptions. The average captured these turbulent times, showing both the initial uncertainty and the subsequent boom driven by wartime demand. It became a daily indicator of the nation's economic mobilization, a reflection of the immense industrial capacity being harnessed for the war effort. By the end of the first 2 decades of the 20th century, the Dow Jones Industrial Average had firmly established itself as the preeminent stock market index in the United States. It had survived panics, recessions, and a world war, consistently providing a clear, if sometimes stark, picture of the market's performance. Its simplicity, its long history, and its association with the authoritative voice of the Wall Street Journal had endeared it to investors and the public alike. It was more than just a number. It was becoming a symbol, a shorthand for the health of American capitalism. The foundation laid by Charles Dow and Edward Jones had proven remarkably resilient, setting the stage for the Dow to become an indispensable part of the national economic discourse for generations to come. The initial vision of Dow and Jones was not merely to create a numerical average, but to provide a consistent, reliable narrative of the market's behavior. They understood that investors, and indeed the general public, craved clarity in a world that often felt chaotic. The Dow, even in its earliest iteration, served this purpose admirably. It offered a daily snapshot, a single figure that could be compared to previous days, weeks, and months. This allowed for the identification of trends that were otherwise obscured by the sheer volume of individual stock movements. This ability to distill complexity into simplicity was its enduring genius, a quality that ensured its longevity and widespread adoption. The process of selecting the initial 12 companies was not arbitrary. Dow meticulously chose companies that were leaders in their respective fields. These were firms that were considered bellwethers for the broader industrial economy. These were not speculative ventures, but established enterprises with significant assets, production capabilities, and market influence. His intention was to create an average that truly reflected the performance of the core industrial engine of the United States. He aimed to avoid being swayed by the volatility of smaller, more speculative stocks. This focus on blue-chip companies, even before the term became commonplace, was a foundational principle that would guide the index's composition for decades. The very act of publishing the Dow Jones Industrial Average in the Wall Street Journal day after day instilled a sense of routine and reliability. Readers came to expect it, to look for it, and to interpret its movements as a sign of the times. It became a topic of conversation in brokerage houses, at dinner tables, and in political discussions. Its numerical simplicity belied the complex economic forces it represented. This made it accessible to a wider audience than any previous financial metric. This accessibility was key to its growing influence, transforming it from a mere statistical curiosity into a vital piece of the national economic consciousness. The early years of the Dow were marked by a gradual process of education and acceptance. It was not an overnight sensation, but rather a slow burn. It gained traction as its predictive and descriptive power became evident. Financial commentators, initially skeptical, began to incorporate the Dow into their analyses, lending it further legitimacy. As the market grew in sophistication and the volume of trading increased, the need for a reliable summary became even more pressing. The Dow was perfectly positioned to fill that role. It was a testament to the foresight of its creators that they anticipated this need and provided a solution that was both practical and enduring. The adjustments made to the average in its early history, such as the increase in the number of components, demonstrated a pragmatic approach to maintaining its relevance. Dow and his successors understood that the index could not remain static in a dynamic economy. It had to evolve, to shed companies that had lost their industrial significance, and to embrace new leaders. This adaptability, while sometimes contentious, was crucial to the Dow's continued accuracy as a reflection of American industry. It was not a rigid monument, but a living, breathing indicator, designed to change as the economy changed. The Dow's journey from a simple arithmetic average of 12 industrial stocks to the widely recognized indicator it is today began with a fundamental premise that the collective movement of leading companies could provide a meaningful insight into the health of the broader economy. Charles Dow and Edward Jones, through their journalistic integrity and statistical acumen, laid the groundwork for this enduring legacy. They transformed fragmented market data into a coherent daily narrative, providing a vital tool for understanding the pulse of American industry. Their innovation, born out of a need for clarity in a chaotic market, would grow to become one of the most iconic and frequently cited economic barometers in the world. A testament to the power of simple, consistent measurement, the stage was set for the Dow to witness and reflect the dramatic booms and busts, the profound transformations, and the relentless march of progress that would define the American century. The conclusion of World War I in 1918 ushered in an era of profound change and unprecedented optimism for the United States. Having emerged from the global conflict as a dominant economic power, America stood on the cusp of a new age. The industrial machinery, honed and expanded by wartime production, now turned its formidable capacity towards consumer goods. This shift fueled a period of remarkable prosperity and cultural transformation. The Dow Jones Industrial Average, now expanded to 20 components and soon to be 30, was perfectly positioned to reflect this burgeoning economic might. It became the daily scoreboard for a nation embracing modernity. The 1920s, famously dubbed the Roaring Twenties, were characterized by a vibrant economy, technological innovation, and a profound shift in social norms. For the first time, a substantial portion of the American population had disposable income, and new products like automobiles, radios, and household appliances became widely available. Factories churned out these goods at an astonishing rate, creating jobs and fostering an atmosphere of boundless opportunity. The stock market, in turn, became a mirror of this exuberance, with the Dow Jones Industrial Average soaring to unprecedented heights. It was a period of speculative frenzy, where the promise of quick riches drew in, not just seasoned investors, but also ordinary citizens. The Dow's ascent during this decade was nothing short of spectacular. From a relatively modest level at the start of the 1920s, it began a steady, then accelerating climb. This reflected the genuine economic growth driven by mass production and consumer demand. Companies within the average, such as General Electric and U.S. Steel, saw their profits swell, and their stock prices followed suit. The public, witnessing these gains, became increasingly captivated by the market. Stories of overnight millionaires fueled a widespread belief that anyone could get rich on Wall Street. This era also saw the popularization of stock ownership. While still largely the domain of the wealthy, more and more middle-class Americans began to invest, often on margin, borrowing money to buy stocks in the hope of quick returns. The Dow became a household name, its daily fluctuations reported in newspapers across the country, discussed in barbershops and at dinner tables. It was no longer just a financial metric for professionals. It was a symbol of the nation's prosperity, a tangible representation of the American dream in action. The index, in a way, became a character in the unfolding drama of the decade. The speculative bubble continued to inflate throughout the decade, with the Dow reaching its peak in September 9. The optimism was pervasive, almost intoxicating. Many believed that the market had entered a new era, where traditional economic rules no longer applied. Expert opinions and public sentiment converged on the idea of perpetual growth. However, beneath the surface of soaring stock prices, there were underlying economic weaknesses, including uneven distribution of wealth, agricultural distress, and an unsustainable credit expansion. The Dow, while reflecting the boom, was also unknowingly signaling the precariousness of the situation. Then came the cataclysm. On October 24, 1929, known as Black Thursday, the market experienced a sharp decline, triggering panic. This was followed by Black Monday and Black Tuesday on October 28th and 29th, when the market plunged dramatically. The Dow Jones Industrial Average suffered staggering losses, wiping out billions of dollars in wealth in a matter of days. This sudden and brutal reversal shattered public confidence and marked the beginning of the Great Depression, the most severe economic downturn in modern history. The Dow's dramatic fall was not merely a reflection of the economic collapse. It was a powerful symbol, and in many ways a catalyst for the ensuing crisis. The psychological impact of the market crash was immense. It eroded trust in financial institutions and fueled widespread fear about the future. Businesses, facing a sudden lack of credit and consumer demand, began to cut production and lay off workers. Unemployment soared, banks failed, and a deflationary spiral took hold. The Dow continued its agonizing decline for the next 3 years, hitting its nadir in July 1932, having lost nearly 90% of its value from its 1929 peak. The Great Depression was a period of immense hardship and profound societal change. The Dow, in its relentless descent, chronicled this national ordeal. Its numbers became a grim daily reminder of the economic devastation. Companies that had once been industrial titans struggled to survive, and many were forced to declare bankruptcy. The components of the Dow themselves reflected this distress, with some companies being replaced as they faltered. The index, designed to measure industrial health, now starkly illustrated its severe illness. The election of Franklin D. Roosevelt in 1932 and the implementation of the New Deal brought a new approach to economic recovery. Government intervention, public works programs, and financial reforms aimed to stabilize the economy and restore confidence. The Dow, while still far from its pre-crash highs, began a slow and uneven recovery throughout the 1930s. This reflected the gradual improvements in economic conditions. Though the scars of the Depression ran deep, the market remained volatile, reacting to every piece of economic news and political development. The outbreak of World War II in Europe in 1939, and America's eventual entry into the conflict in December 1941, fundamentally reshaped the American economy, and consequently, the trajectory of the Dow. The immense demands of wartime production pulled the nation out of the lingering grip of the Depression. Factories that had been idle or underutilized roared back to life, producing tanks, planes, ships, and munitions on an unprecedented scale. Unemployment plummeted as millions joined the armed forces or entered the workforce to support the war effort. The Dow Jones Industrial Average reflected this dramatic industrial mobilization. Companies within the index, particularly those involved in heavy industry and manufacturing, saw their production capabilities stretched to the limit. The focus shifted from consumer goods to military hardware, and the Dow's components adapted to reflect this new reality. The index saw a steady rise during the war years, driven by massive government spending and full employment. It was a period of forced prosperity, where economic growth was directly tied to the war effort. The war also brought about significant changes in the composition of American industry. Companies that had been dominant before the Depression might have faded, while new leaders emerged. The Dow, through its careful selection process, aimed to remain representative of the nation's leading industrial enterprises. It captured the shift in focus towards defense industries and the immense output required to sustain a global conflict. The market, while still subject to the anxieties of war, largely moved upward, mirroring the nation's growing economic power and its role as the arsenal of democracy. As World War II drew to a close in 1945, there was widespread concern that the end of wartime production would lead to a return of the Depression. However, the American economy, bolstered by pent-up consumer demand, savings accumulated during the war, and the GI Bill, transitioned remarkably smoothly into a post-war boom. The Dow Jones Industrial Average continued its upward trajectory, reflecting this robust economic rebound. Soldiers returned home to find jobs, families began to buy houses and appliances, and the nation entered a new era of prosperity. The post-war period saw the Dow solidify its position as the primary barometer of American economic health. Its long history, having weathered the speculative excesses of the 1920s, the devastating crash, and the unprecedented mobilization of World War II, lent it immense credibility. It had proven its resilience and its ability to reflect the profound shifts in the nation's industrial landscape. The index, once a mere statistical curiosity, had become an indispensable part of the national consciousness, its movements eagerly watched as a sign of the times, a reflection of the triumphs and tribulations of the American economy. The period immediately following World War II saw the United States enter an era of unprecedented global influence and domestic prosperity. The Dow Jones Industrial Average, having weathered the storms of the Depression and the war, continued its upward trajectory, mirroring the nation's economic strength. This was the dawn of the Cold War, a geopolitical struggle that would define international relations for decades. While not directly impacting daily stock prices in the same way as a domestic economic boom or bust, the Cold War subtly influenced the composition and performance of the Dow. Defense spending became a significant component of the national budget, bolstering industries involved in aerospace, electronics, and advanced manufacturing. The post-war boom was driven by several factors. Returning soldiers fueled a housing boom and a surge in consumer demand. Eager to purchase the goods that had been scarce during wartime, the baby boom generated new markets, and the expansion of the middle class created a vast consumer base. Companies within the Dow, such as General Motors, Procter & Gamble, and IBM, became global giants, their products and services reaching every corner of American life, and increasingly, the world. The Dow, now firmly established as the leading market indicator, reflected this sustained period of economic growth and stability. However, the Cold War introduced a new layer of complexity and occasional volatility. Periods of heightened tension, such as the Korean War in the early 1950s or the Cuban Missile Crisis in 1962, could trigger brief market jitters. Defense contractors and technology companies, often at the forefront of innovation driven by military research, saw their fortunes tied to government contracts and geopolitical developments. While the Dow remained broadly representative of industrial America, the undercurrent of the Cold War meant that certain sectors, particularly those with defense ties, gained increased prominence within the index. The 1960s brought both continued economic expansion and growing social unrest. The Vietnam War, which escalated significantly during this decade, had a profound and increasingly divisive impact on American society and its economy. While initially stimulating some sectors through increased military spending, the prolonged conflict led to rising inflation and a growing national debt. The Dow, which had enjoyed a generally bullish run through much of the 1950s and early 1960s, began to reflect the strains of the war and the changing economic landscape. The late 1960s and 1970s proved to be a challenging period for the Dow. The optimism of the post-war era gave way to economic uncertainty, characterized by stagflation, a toxic combination of stagnant economic growth and high inflation. The oil crises of 1973 and 1979, triggered by geopolitical events in the Middle East, sent shockwaves through the global economy. Energy prices soared, production costs increased, and consumer confidence plummeted. The Dow struggled to break through resistance levels, often trading sideways for extended periods, a stark contrast to the booming decades that preceded it. During this era, the concept of the Nifty 50 emerged, a group of large-cap growth stocks that were seen as safe investments regardless of market conditions. While not an official index, these companies often included Dow components and represented a shift in investor focus towards consistent growth. However, even these seemingly invincible stocks eventually succumbed to the broader market downturns of the 19th. The Dow, as a whole, reflected the pervasive sense of economic malaise and the challenges faced by traditional industrial companies. The 1970s also witnessed the rise of conglomerates. Companies diversified aggressively, acquiring businesses in seemingly unrelated industries in an attempt to achieve growth and stability. This trend presented a challenge for the Dow, which was designed to represent industrial America. As companies became more sprawling and diversified, their core industrial identity sometimes blurred. The index committee had to continually assess whether a company still fit the industrial criteria, leading to adjustments in the Dow's components to maintain its relevance. Despite the economic headwinds, technological shifts were quietly brewing beneath the surface. While the Dow remained dominated by traditional industrial giants, the nascent technology sector was beginning to take shape. Companies like IBM, already a Dow component, were at the forefront of computing, laying the groundwork for the digital revolution to come. However, the full impact of these emerging technologies on the broader economy and the Dow itself would not be felt until later decades. The index, by its nature, tended to be a lagging indicator of truly revolutionary shifts, preferring established giants over speculative newcomers. The end of the 1970s and the beginning of the 1980s marked a turning point. The election of Ronald Reagan and the implementation of supply-side economic policies, coupled with a determined effort by the Federal Reserve under Paul Volcker to combat inflation, set the stage for a new era of economic growth. The Dow, which had been largely stagnant for a decade, began to show signs of renewed vigor. This period would lay the groundwork for one of the longest bull markets in history, fundamentally reshaping the financial landscape and the Dow's role within it. The challenges of the Cold War, the Vietnam conflict, and the economic turmoil of the 1970s tested the Dow's resilience and its ability to reflect a rapidly changing America. It showed that even the most established index was not immune to the forces of geopolitics and economic cycles. Yet through it all, the Dow remained a consistent, if sometimes somber, barometer. It continued to be the most watched and discussed measure of the nation's industrial health, adapting its components to reflect the evolving corporate landscape, even as the industrial label began to stretch to accommodate a more diversified and complex economy. The stage was now set for the digital revolution to truly take hold, forever altering the face of American industry and the Dow itself. The 1980s marked a significant turning point for the American economy, and by extension, the Dow Jones Industrial Average. Following the economic struggles of the 1970s, a new era of growth and technological advancement began to take hold. This decade saw the burgeoning influence of personal computing and the early stages of the Internet. These forces would fundamentally reshape industries and redefine what it meant to be an industrial giant. The stock market, after years of stagnation, began a remarkable ascent. This was fueled by a combination of factors: declining inflation, deregulation, and a renewed focus on corporate profitability. The Dow, reflecting this newfound vigor, embarked on what would become one of the longest and most powerful bull markets in history. The 1990s witnessed the full-blown digital revolution. Personal computers became ubiquitous, and the Internet transitioned from a niche academic tool to a mainstream phenomenon. This era saw the emergence of entirely new industries centered around software, networking, and e-commerce. The Dow Jones Industrial Average, traditionally composed of older established manufacturing firms, faced the challenge of adapting to this new economic landscape. While some tech companies like IBM were already components, the index gradually began to incorporate more technology-oriented firms, reflecting their growing economic importance. The latter half of the 1990s was dominated by the dot-com bubble. Speculation in internet-related companies reached fever pitch, driving stock prices to unsustainable levels. The Dow, though less exposed to the most speculative internet startups than the Nasdaq, still benefited from the general market euphoria, reaching record highs. However, the bubble inevitably burst in early 2000s. Many internet companies, lacking sustainable business models, saw their valuations collapse. The Dow experienced a significant downturn, though its decline was less severe than that of the tech-heavy Nasdaq. This period highlighted the inherent risks of speculative bubbles, even for a venerable index like the Dow. The turn of the millennium brought new challenges and opportunities. Globalization accelerated, with companies increasingly operating across national borders, sourcing materials, manufacturing products, and selling to customers worldwide. The Dow's components began to reflect this interconnectedness, with many member companies having substantial international revenue streams. The early 2000s were also marked by geopolitical events. Most notably, the September 11th terrorist attacks in 2000. These events caused immediate market disruptions and a period of uncertainty, which the Dow reflected. However, the market and the economy demonstrated resilience, gradually recovering in the years that followed. The mid-2000s saw a period of sustained growth, but this was underpinned by an unsustainable housing bubble and lax lending practices. The Dow continued its upward climb, reaching new highs, yet the underlying fragility of the financial system was becoming increasingly apparent. Then came the financial crisis of 2008. The collapse of the subprime mortgage market triggered a cascade of failures across the financial sector, leading to a global economic meltdown. The Dow Jones Industrial Average suffered one of its most dramatic and rapid declines in history, rivaling the percentage losses seen during the Great Depression. Government bailouts, corporate bankruptcies, and a severe credit crunch sent shockwaves through the economy. The Dow's plunge was a stark indicator of the depth of the crisis, reflecting the widespread fear and uncertainty that gripped investors and the public alike. Following the crisis, central banks around the world, including the U.S. Federal Reserve, implemented unprecedented monetary policies, such as quantitative easing. These measures aimed to inject liquidity into the financial system and stimulate economic recovery. The Dow began a slow but steady recovery, eventually surpassing its pre-crisis highs. This era also saw the continued growth of passive investing, with index funds and exchange-traded funds (ETFs) gaining immense popularity. This trend meant that more investment capital flowed directly into indices like the Dow, further cementing its influence on the broader market. The information age continued its relentless march, and the Dow continued to evolve its composition. Companies in software, internet services, biotechnology, and healthcare gained increasing prominence within the index. The industrial label, while historically significant, became increasingly broad, encompassing a diverse array of sectors that drive the modern economy. The 2010s were largely characterized by a sustained bull market, driven by technological innovation, corporate earnings growth, and low interest rates. The Dow consistently reached new milestones, reflecting the strength of leading American corporations and the overall expansion of the economy. This period also saw increasing discussions about the Dow's relevance in a world dominated by market capitalization-weighted indices like the S&P 500. Its price-weighted methodology and limited number of components were often cited as drawbacks. Yet its historical significance and widespread recognition ensured its continued prominence in financial news and public discourse. The Dow's journey through the digital revolution and globalization has been one of continuous adaptation. It has reflected the booms and busts, the technological leaps, and the economic crises that have defined the 21st century. It remains a powerful, if imperfect, barometer of American corporate strength and economic health, poised to reflect the next wave of innovation and global change. After more than a century of existence, the Dow Jones Industrial Average stands as an enduring symbol of American capitalism. It has witnessed profound economic shifts, technological revolutions, and global transformations, consistently reflecting the pulse of the nation's leading corporations. Today, the DJIA remains one of the most frequently cited and widely recognized stock market indices in the world, a testament to its historical significance and its simple, yet powerful narrative. Its longevity speaks volumes about its ability to adapt and remain relevant in an ever-changing financial landscape, even as new, more complex metrics have emerged. Its current composition, now fixed at 30 companies, represents a diverse cross-section of major U.S. industries. These are not necessarily the largest companies by market capitalization, but rather established leaders in their respective fields, chosen for their reputation, growth, and broad representation of the economy. The selection process, managed by a committee at S&P Dow Jones Indices, aims to ensure that the index remains a true barometer of the industrial sector's health, broadly defined. The calculation method, while still price-weighted, has evolved to account for stock splits, spin-offs, and other corporate actions through the use of a Dow divisor, a dynamically adjusted number that ensures continuity in its value and prevents such events from artificially distorting the index. This divisor is a critical, though often unseen element that maintains the integrity of the Dow's historical comparisons. Despite its iconic status and long history, the Dow faces considerable scrutiny and criticism in the modern financial landscape. Its primary critique revolves around its price-weighted methodology. Unlike market capitalization-weighted indices, such as the S&P 500, where a company's influence is proportional to its total market value, the Dow gives greater weight to stocks with higher per-share prices. This means a $1 move in a $300 stock has a far greater impact on the index than a $1 move in a $50 stock, regardless of the company's actual size or economic footprint. For example, if a high-priced but relatively smaller company experiences a significant price swing, it can move the entire Dow more dramatically than a much larger, lower-priced company. Critics argue that this price weighting can distort the true picture of market movements. They contend that it prioritizes share price over fundamental economic importance, potentially leading to situations where the Dow's movements do not perfectly align with the broader market's overall performance, particularly when compared to market cap-weighted benchmarks. This can be misleading for investors seeking to understand the true aggregate value changes in the market. Furthermore, the committee's discretionary power in selecting components and adjusting the divisor can sometimes be seen as less transparent than purely quantitative index methodologies. Another common criticism is the Dow's limited number of constituents. With only 30 companies, it represents a very small fraction of the thousands of publicly traded companies in the U.S. economy. While these 30 are indeed large and influential, often multinational corporations, some argue that they cannot fully capture the breadth and diversity of the modern American economy. This includes the rapidly growing small and mid-cap sectors, or the nuances of emerging industries that might not yet have a blue-chip representative. For instance, a significant boom in a particular niche technology, or a widespread downturn among smaller businesses, might not be adequately reflected in the Dow's movements, leading to an incomplete economic picture. Despite these criticisms, the Dow's relevance endures, largely due to its powerful role as a narrative tool. For generations, it has been the go-to figure for financial news outlets, politicians, and the general public to quickly summarize the state of the stock market and by extension, the economy. Its round numbers and historical context make it easily digestible and relatable, even for those without deep financial knowledge. It serves as a simple, easily communicable shorthand for complex market dynamics, often becoming the first number cited when discussing daily market performance. The Dow's psychological impact is undeniable. A Dow up 200 points headline immediately conveys a sense of market optimism and economic progress, while a Dow down 500 points signals concern and potential economic headwinds. This makes it a crucial indicator of investor sentiment and public confidence, often shaping perceptions of economic health more broadly than more complex or comprehensive indices. It simplifies a complex world into a single understandable figure, influencing consumer spending, business investment, and even political discourse. Its daily fluctuations are not just numbers, they are interpreted as indicators of national well-being. Looking to the future, the Dow will continue its process of adaptation, a characteristic that has allowed it to survive and thrive for over a century. As new industries emerge, and existing ones transform through disruptive technologies, the Index Committee will face the ongoing challenge of ensuring its components remain representative of the leading sectors of the American economy. The rise of artificial intelligence, biotechnology, renewable energy, quantum computing, and other frontier technologies will likely prompt further adjustments to its composition, as the committee strives to keep the industrial in its name relevant to the industries of tomorrow. The debate over its methodology and representativeness will also persist within academic and financial circles. However, its deep historical roots, its widespread recognition, and its unparalleled brand equity ensure that the Dow Jones Industrial Average will likely remain a prominent fixture in financial discourse. It may not be the most scientifically precise measure of the market, nor the most comprehensive, but it is undoubtedly the most iconic. Its simplicity is its strength, allowing it to transcend mere data and become a cultural touchstone. In conclusion, the Dow Jones Industrial Average stands as a remarkable testament to the foresight of Charles Dow and Edward Jones. From its humble beginnings as a simple average of 12 industrial stocks, it has evolved into a global icon, reflecting the triumphs and tribulations of the American economy for over a century. It is a flawed but undeniably powerful barometer, a constant presence in financial news, and a symbol that continues to capture the imagination of investors and the public alike. Its journey is a microcosm of America's economic history, a pulse that beats on, reflecting the ever-changing landscape of industry and innovation, and continuing to serve as a vital, if sometimes controversial, mirror to the American economic spirit.